Jordan, hello. So good to see you. And a very special hello to everybody who is watching us live on your YouTube channel. We're so glad you're here. I know, Jordan, you said that we had a big contingency who pre-registered, so thank you for that. And of course, if you want to share this with your friends later, we will include a link to the broadcast and a copy of everything that we're going to talk through today, which is a lot, Jordan. We're talking through 2025's biggest market stories and what's ahead for 2026. Why was it important for you to have this event live for everybody today?
Yeah, we want to educate the community and especially our clients, but we also believe we want people's feedback. We want their questions. And a lot of times we do education in a live one-on-one, but it's hard for people to attend. So we thought this around lunchtime, if people are still working, hopefully they can jump on. But we were encouraging everyone here on this call, live or if you're coming on, to kind of put your questions in the chat. Throughout the presentation, we are going to be kind of popping those up because we want to tailor today and everything we do to the clients that we serve. So this is about you, the people that are watching. So if you have questions, put that in the comments, ask, and Aaron will pop that out throughout the presentation. And we believe as a firm, as being whole service, we want everything from tax planning to legacy to income to healthcare planning. But really investments are a big part of that too. Today, we're going to focus on the investments, and we thought Mark DiOrio, our CFA, is the best person to do that. So we're going to kind of talk through a bunch of things, get your questions, and hopefully give you some more confidence and clarity as we not only look back in 2025, but more importantly, let's look forward in 2026 and what's going to come.
Right. A lot to get to. Mark, it's so good to have you with us. I always enjoy talking things through with you. We have a lot to get to. As we all know, it's been a very interesting year already in the markets, interest rates, earnings, AI, consumer health, and global forces. So today, Mark, I want to talk through those key themes that are shaping markets and detail what investors should be paying attention to moving forward. So, of course, we have a lot to get to. Let us start with the 2025 year in review. Looking back at 2025, what were the biggest market surprises and what lessons should investors take from the year?
Well, hi, Aaron. Hi, Jordan. Great to be with you guys. And this is an important chart. And the implication of this chart really leads into what we've seen unfolding into 2026 already. And what this chart shows is the blue line there is the S&P 500, so the broad gauge of the U.S. stock market. The green line there represents the Mag 7 tech-related stocks. So these mega cap tech stocks, they represent almost 40% of the entire S&P 500 index. The red line there is the S&P 500 without the Mag 7. So basically 493 stocks. The point of this chart is showing that you had a pretty big decline in the Mag 7 stocks beginning in mid-February that didn't recover until the end of June. Whereas the other 493 stocks actually dropped in about April and recovered in April. But then you can see the tail end of the year where the Mag 7 stocks actually took over the lead. The point of this chart is showing that, number one, the index is very concentrated in those 7 stocks. So it doesn't reflect the rest of the market, which maybe do something completely different. And in this case, it actually held up during a tough time, during kind of the tariff tantrum and the market selling off at that point in time. Most stocks were actually not that affected, but because the S&P 500 is so concentrated in those stocks that it can pull the overall market down. And so this is an important concept as we get into 2026, that knowing that we're pretty heavily concentrated in those 7 stocks with the broad market, and we want to keep in mind diversification and being fully diversified when we build out our portfolios.
Yeah, that April sell-off was a little bit hairy. Jordan, I don't know if you fielded any questions from clients, but at least what's nice, again, we will return to this theme. When you have a financial plan, you know that volatility is built into the plan.
And I will say during that time, that was actually an opportunity zone for a lot of clients that we can maybe execute on Roth conversions. It was a short window, right? Only a couple of days, but that's when we provide financial leadership and want that clarity and confidence so people are not stressed and we actually can take action, not just sit in the sidelines.
Right. All right. So let's move on to interest rate policy. How should investors think about Fed policy, Mark? And why is the path of rates often more important than the next move?
Sure. The Federal Reserve and the chairman is Jerome Powell, at least for now, for the next couple of months. But the Fed has what's called a dual mandate. So their job is full employment. By that, when they're managing interest rates, is to look at, is unemployment below 5%? And that would be considered full employment. and also to maintain stable prices. And as a rule of thumb, that means about a 2 to 3% inflation rate. So if inflation is running high, they will raise interest rates to slow down the economy, slowing down inflation. And if unemployment is high, then they will try to reduce interest rates, trying to stoke the economy, support the economy. Ultimately, if you have a rising rate interest rate environment, that can actually be a headwind for stocks. And we saw that into 2022, where they were raising interest rates because inflation was elevated. So they were trying to get that under control, but that can definitely be a headwind for stocks. And we saw a bear market in 2022 for stocks. And then the Fed just started to reduce interest rates after a 9-month pause, so at about 3.5% on the overnight rate. That's what the Fed changes. And so the expectations is for 2 more rate cuts this year. That may change as data comes out, but the path is definitely lower, not higher. And that's what is important for the market.
Mm-hmm. Mark, do you think the question of are we in, will we be in a recession, is that question behind us?
Yeah, I think the market's been looking for a recession for several years now, and it's
Right.
always right around the corner. But remember,
Yeah.
recessions, even though maybe you think it's growth or recession, it's 50-50. It's really you're only in recession about 15% of the time. So a lot of times people overestimate the expectation of a recession, which is 2 negative quarters of GDP growth. And so I don't think the recession concern currently is the issue for the market. Possibly rotation is the issue, meaning maybe out of some of the big cap tech stocks, the darlings, and into the rest of the market that has been unloved and underowned.
Mm-hmm. All right, let's talk about earnings now. And then just a reminder to all of the wonderful people who are watching us live right now, if you have any questions, feel free to submit them as they come up and we will be happy to answer them. Don't feel like you need to wait until the end. Okay, Mark, earnings now. What does the earnings picture tell us about the underlying strength or fragility of the market right now?
So despite all the headlines, and there's always headlines, there's always news that can maybe move the market kind of from day to day, the gyrations, the market has been remarkably resilient. And the reason for that is that earnings, this blue line here, have really accelerated out of that 2022 bear market. And we had, in this case, over 80% of companies outperforming their earnings expectations. So positive earnings surprises. The bottom line is earnings have been very strong across the S&P 500, but also now across the mid cap and small cap space. And they're running at about 90% earnings expectation or earnings surprises. So this has been very strong underneath the hood. And so when you're ever worried about what's happening with the market, you have to look at earnings. And if they're strong, any sell-off will ultimately run its course, and then the market will resume its uptrend to follow the path of those earnings.
Okay.
Do you mind if I jump in, Mark? I know some clients are a little bit uneasy with kind of political concerns, just in the president, what might happen in the world. I've had a few questions the last week on that. Kind of what's your thought from a market's perspective? President's Venezuela, we got different things going on in the world. What is your 2 cents on that, kind of just off the cuff?
So geopolitical events really don't have a long-lasting impact on the market. So the study that we've looked at shows it's about a 2-month impact. So if you think of if you have a downward move in market, so if you even think of when Russia invaded Ukraine, the market kind of digested that within 2 months. You had a downward action in equities. You had upward prices in oil. But you fast forward to today, and oil's in the $60 range, well below where it was at that time when there were concerns. And so, yeah, oil can always jump higher on these geopolitical events and kind of throw noise into the system, but it always reverts back to earnings. And if you have positive earnings, ultimately prices will follow that way. So what has been surprising is really how well the market and companies have operated in a challenging environment since post-COVID, but earnings have remained pretty strong.
Right.
And the market's resilient. It's based on earnings, but we also as a firm want to base things on a plan, and that kind of complements each other.
Definitely.
All right, let's keep moving along. I want to talk through the narrow leadership that we're seeing. This chart shows narrow market leadership. So why does this matter, and what risks or opportunities does this create?
Historically, about 50% of stocks in any given year outperform the index, the S&P 500, and 50% underperform. Well, that makes sense. But in the last 3 years, we've had this really unusual environment where less than 30% of stocks outperform the index, meaning 70% plus underperformed. That's an unusually high number. So you may have stocks and you're saying, boy, they're really underperforming. Well, that's where the opportunity comes in, where you say there's a lot of stocks that really didn't participate in this kind of tech, mega cap tech driven rally that we've had. And so I think there's a lot of opportunity, and that's the kind of the other 493 stocks that have room to participate, to rally. They don't get the headlines or a lot
Right.
of the excitement around the tech, but there's still good companies, and if they're trading at reasonable valuations with earnings growing, now the market can rotate into other areas that may benefit from this period.
Mm-hmm. All right. When certain market segments look stretched like this, what does this typically signal for future returns?
So this is a classic mean reversion concept. You revert to the mean or the average. The bottom clip there, I know it might be hard to see if you haven't looked at charts like this before. And granted, the fonts are very small. The bottom shows the cyclical growth sectors. So this is consumer discretionary, technology, consumer communication services. These are dominated by the Mag 7. So
Okay.
technology, it's Apple,
Yeah.
Microsoft, and NVIDIA are over 50% of that sector, for example. Anyway, they're about double, maybe not quite double its average, its long-term average in terms of the weight in the S&P 500. But then you go up above that, and in orange, energy, materials, industrials, financials, near its low going back 50 years. And also consumer staples, healthcare, utilities, real estate, also near their 50-year lows, while those growth sectors are at 50-year highs. This would tell you, again, you can have a rotation in the market where you'd have 8 of the 11 sectors actually do well, and maybe the 70% plus of stocks actually do much better. And we see that to start this year for sure.
Mm-hmm. Mark, thank you for that. Jordan, I want to pop in with a quick question, and you and I record videos on the regular, but we had a question from Bob. And I think that this is something that we've talked about often when it comes to emotional investing. You mentioned the importance of diversification. Do you think silver would be a good investment now after its recent large pullback? Some analysts say it is in a structural deficit. My initial reaction, and I know we're not tuning in to hear my opinion, but it's so hard not to want to chase these sectors that are doing well. But Jordan and then Mark, maybe you can both respond to that.
Yeah, well, I'll say as a firm, we don't try to chase trends, right? International
Right.
market, gold, silver. We base everything on a plan. We want you to get competitive returns, but we also don't want to chase the next hot stock or the next trend, because that's where people can get in at the wrong time and not be able to get out at the right time. So we want to make sure we focus on the plan and not chase trends, but also we look for opportunity zones in different sectors. And that's where Mark and his leadership helps us find these opportunity zones. And I'll kick it to Mark now.
Sure. So silver is about 3 times as volatile as gold. So gold is a traditional portfolio diversifier, can be held kind of more of a monetary asset than silver is. Silver does have about 50% industrial use, which is way higher than gold, for example. So it is part of this maybe materials trade, if you will. You just have to be careful with the volatility. And so, and then you go to, well, what's the appropriate allocation? And that's where Jordan and his team come in and say, well, what's the appropriate allocation to get in your portfolio to make sure it fits and adds a diversification element to that portfolio as well.
Yeah, it is interesting because it's hard to tune out the headlines. I was reading one of my news digests this morning. One of the jewelry companies that's popular with my daughter, they've switched to making the jewelry in platinum now because it is cheaper than silver, which is wild to me. Okay, let's move along. I do want to talk about big tech CapEx here. Big tech spending is accelerating. How important is capital expenditure to sustaining market growth?
So this is the story behind kind of the numbers or what's happening in the economy, which is this shift towards AI, artificial intelligence, and the build out thereof. So a new term has really come in the lexicon, which is hyperscalers. These are the mega cap tech stocks building out the infrastructure needed for AI or this next generation in the economy. And in the blue bars there, it shows cash flow from operations for 4 companies, Microsoft, Amazon, Google, and Meta. And then down below shows, well, what are they doing with that cash flow? And what you'll notice is accelerating cash flow to these companies helps supporting their company stocks. But they, on the flip side, they're spending more and more in investing activities to build out what's necessary in this next phase to kind of be the leaders for artificial intelligence. And so that spending is going in the economy. I saw estimates early on, the last 2 years that would say, oh, maybe there's 100 billion, 200 billion for AI build out. Well, those 4 companies just spent 100 billion alone last quarter. That doesn't even include Tesla and some of the other large players in the space. So the estimate is probably closer to 3 to 5 trillion, and that may turn out to be light over the next few years. So this spending is real, and it's going out of those large cap companies into the rest of the economy, into other areas, and that's also going to be a beneficiary to the small, mid cap, and value stocks.
Mm-hmm. All right. And again, just a kind reminder to everybody who's watching, feel free to drop in your questions or comments and we can answer them live. That being said, if you are watching this as a recording, you can always put your question in the comments and Jordan and his team will get back to you as well. So Mark, I'm really glad you brought up AI because that is just the talk of the town right now. How real is the AI-driven economic shift and where do you see genuine long-term opportunity versus hype?
Well, this is a major infrastructure build out, and this goes, and this chart does a good job of showing the layers, again, small fonts, but it shows the layers necessary. So you're talking about from water to copper to silver, rare earths in there, uranium's in there for power, and maybe this next generation of power that's going to be necessary. But then above that, you get into electrification, the power grid that's needed, renewable energy. Then you go up into the kind of the data centers, cloud computing, cybersecurity, and then above that, the top layer with robotics and AI and autonomous and health tech. Basically, now it goes out into the economy. So there's a lot of layers here, and when you for this spending and the amount of spending, there's only so many companies that can spend what's necessary to build this out. So this is kind of exciting, and it is really what's caught the market's attention the last 2 years.
Right. And then on that note, semiconductors. Why are semiconductors so central to today's investment story?
So you need really 3 things for this AI build out, in addition to all those layers, but 3, to paint it with broad strokes, you need semiconductors, data centers, and energy. And semiconductors is the leading kind of area. Semiconductors are those chips, those little chips that are in computers, cell phones, and everything. What they do is they process and store data. So if your computer's thinking, processing data, or if it's storing those documents and so forth, well, this takes it up to the next generation, which is needing to process and store a lot of data. The leading chip manufacturer for AI, or chip designer, I should say, is a firm called NVIDIA.
Right.
They are the leader in advanced semiconductor design. They now represent 8% of the entire S&P 500. You have to go back 50 years when IBM had that role to give you an idea of how popular NVIDIA became over that short period of time. And so it's pretty unusual for a stock to have that big a dominance, especially in an economy as diverse as the US, that NVIDIA grew to those heights. So that's been the leading edge in terms of semiconductors. There are other semiconductor players as well that are needed as part of this build out, but that's why NVIDIA became the largest company in the US, over $4 trillion market cap, and this move has propelled it into being the largest stock going back 50 years in the index.
Right. Really incredible. I'm glad you were talking about market cap too. I'm going to hop in with an off the cuff chart that Jordan, you and I have used before. This is from FinViz, which shows the S&P 500 according to market cap. Now, Jordan, we've talked before, and we mentioned at the beginning here about concentration risk. We invest in the S&P 500. We think we are diversified because we are invested in 500 companies. But Jordan, explain how that might not be the case.
This is where we try to educate people that the S&P 500, it is 500 and that seems diversified, But if you look at the cap, it's 7 of those companies that really drive the major weight of that. So if 2 or 3 of those companies have a bad, year, your whole portfolio might have a bad year or be severely impacted because there's so much weight. I think Mark said over 40% is weight in those top 7 companies. So when we look at market returns, we don't just compare to the S&P 500. We look at kind of many different indexes. We try to diversify. We use different tools like structured notes. We can sometimes use safe money investments like annuities, but ultimately we create a plan and then we overlay taxes on top of that plan. Because maybe we put money in NVIDIA, we put it in an IRA, and we did so well. That's the good news. That's also maybe the bad news, because now your tax liability is so much higher because anything you take out will be taxed. So if we are going to be more aggressive, if we are going to put money in these kind of higher tech, more volatile stocks, generally speaking, we want to put those more in Roth IRAs, because all that growth, if it goes up 200-300%, all that growth will be then tax-free. So we want to align the portfolio with the purpose, A, but then also with the tax plan to make sure we don't give more of our hard-earned money to the IRS. We keep more in our pockets.
Right. And this is also, it dovetails with the question. A lot of the times when we hear financial headlines, what we are hearing about is the S&P. And I don't know if you field these phone calls, Jordan, but people want to know, hey, the S&P is up 10. Why am I not up 10%?
Yeah, we don't get those phone calls a whole lot because we try to educate and have a plan.
Right.
So
Good.
we're not trying to compete with the S&P 500, right? We have a team of advisors, but we want to also, more importantly than look at the S&P 500, we want to look at the person, the family, and say, what are you comfortable with? So we actually use a tool called Nitrogen. It's a third-party software that actually analyzes everyone's current portfolio, shows them how much they can make, shows them how much they could lose. And we also realign to make sure, are you comfortable with that, right? Because the market has risks, but we want to make sure you're not taking too much risk, or maybe you're not taking enough risk, but we want to every few years kind of reevaluate that and make sure you're comfortable with whatever risk you're taking. But it's not a comparison S&P, my portfolio, because that's not apples to apples, that's apples to oranges. It's just not exactly the same thing.
Right. Bears repeating. Okay, let's talk about data centers now. And I am going to pull that up here. There we go. What's driving the explosive growth in data centers, and how should investors think about this trend?
Well, so this is the second component that you need, semiconductors being one, to help process enough information to have AI work, which uses statistical inference, essentially. You need data centers to run and to store these semiconductors and run them. And so data centers have been exploding onto the scene. Data center spending has overtaken office spending. And so any decline that you see in the office space, that has been picked up by data centers. So it's really just shifted. And I think that's a reflection of the overall economy. But the other point of this chart is to say, this is really maybe 3 years old. So we're actually pretty early in this AI move still, even though maybe you've seen it in headlines and it's been talked about in the financial process. It's really only about 2 to 3 years old. So still pretty early. And to build out a data center, these are big warehouses. So one of the hyperscalers or independent players, there's a number of independent players, they may buy up, we're talking about 300 acres of property.
Right.
And then they're going to build buildings, very large buildings, essentially like warehouses, but you put in servers to run them. And so they'll come in, and when they come in, it's usually $1 billion to $10 billion just to get going. And so they'll come in, and you see this almost everywhere across the country. They're moving into just about every state to build out data centers.
Mm-hmm. And that must bring us to our next question, which is energy, right? All those data centers need a lot of energy, which often gets less investor attention. But of course, that's changing. What role does it play in today's market and the inflation outlook?
So part of the data center story is what they need to operate and how much electricity specifically that they need to operate. How much power do they need? And really, you might see in local communities that all of a sudden communities are looking at this saying, wait a minute, maybe we should talk about these data centers coming in, because they're going to essentially double the electricity needed in that surrounding area. They're also going to need water for cooling. And so there's a whole infrastructure build out, but then there's a real impact in terms of, well, what does that do to the electricity bill? And that's already being talked about, I think, in the local communities. So how do you get the power, enough power to generate these data centers? So that was one of the reasons for our uranium or nuclear renaissance, so to speak. So these are not these big nuclear power plants. These are SMR, small modular reactors, that can help power the data center specifically. And so these large companies are coming in trying to work with communities of how that is going to play out without really exploding the prices of electricity and so forth. So I think that could be a sticking point this year as everyone figures out what is the appropriate plan, because really you're almost doubling the electricity need in communities. That's how much power the data centers are needed and using.
Yeah, no, this is really interesting. And of course, this brings us to another important factor when we talk about markets, which is consumer sentiment. Of course, we have to think about how people feel because, as we just talked about, investing can sometimes be emotional. But how we know this can swing quickly, Mark. How reliable is this as a signal for the markets?
This is interesting where you have the AI theme, but then you have which the market is enjoying. And then you have the reality of how are consumers feeling. And consumer sentiment right now is at essentially 45-year lows. You wouldn't get these numbers, and sometimes don't even get them in recessions. So the
Right.
consumer feels terrible. I would use this sentiment number, though, as a contrary indicator, meaning consumers are kind of down and out, don't feel very, very good, that they're susceptible to positive surprises. And that could come in from a variety of different forms. One, maybe it's not as bad as expected. Maybe prices don't rise as much as expected. Maybe affordability improves. Maybe there's some other policy incentives, whatever it happens to be. But that's what you get when you look at sentiment data. Most of the time, we use that as a contrary indicator. So a lot of pessimism is actually supportive of the U.S. consumer, even though we don't feel very good.
Yeah.
Mark, just to jump in there, I know a lot of evaluations are in uncharted waters and things. We haven't seen AI. We haven't seen these different things, and people are sometimes concerned. Like, based on that just chart there, a lot of people are thinking negatively. And again, we don't have a crystal ball. We can't predict the future. But to talk to those people kind of directly and how they're feeling, how could you maybe supportive or maybe just kind of give your 2 cents on, are you that negative on the markets? Kind of what's your stance on that?
So that chart was really about consumer sentiment, how they're feeling, how their prospects are. And I think it's because they feel a little bit left out of the AI move. In other words, it hasn't really impacted consumers just yet in terms of the efficiencies, maybe some of the cost reductions that is kind of promised, the productivity. We're seeing a little bit of a productivity jump. But anyway, the consumer hasn't really been part of this move. And that's where that chart comes into play. On the stock market side, and I think we might have a chart on this, it's actually different. And I'll hold my thoughts until we get to that and what the consumer thinks about the stock market, because it's actually in a big contrast to how they're feeling from a sentiment perspective on their own situation and own expected spending.
Gotcha.
Yeah. Sorry, Mark. If you know the number of the slide, I can hop there. I have costs for us next. Do you want to just hold that thought until we get there?
Yeah, let's just hold that thought, because this slide on costs really just explains a lot of why the consumer probably is feeling bad. It's because, well, as we all know, costs in general have risen. It's about, on average, 25% higher. Spending is 25% higher over the last 5 years. So that inflation idea, inflation was very low for a long period of time, but now it's quite elevated. So you have an elevated kind of an affordability issue here. And so we're paying more for everything. So inflation is generally measured year over year. And if we say inflation is slowing, it usually doesn't mean prices are coming down. It just means they're not going up as fast as they were. But here you can look at, on average, it's total spending is up 25%. But if you look at things that you need, vehicle insurance, mortgage insurance, lodging, non-alcoholic beverages are up over 50%. So there's a real feel here,
right,
in terms of I think the reason or the rationale that consumers feel a little down.
Right. And of course, inflation chief among those reasons. It has cooled from its peak, as you just mentioned, but still feels stubborn, especially at the grocery store. So, what can we expect moving forward? Do you think this trend is sustainable?
The market looks at macro data, so not every data point actually impacts the market. It looks like at the overall information. On the left-hand side, the blue line there actually does show, and it's kind of a forward-looking model, that inflation has come down and is going to be relatively stable in that 2 to 3% range. In other words, uh, uh, on the right-hand side, you have the major components: goods, labor, housing, monetary conditions, all actually show moderating inflation. The only one that's higher here is consumer expectations. And so I think that's playing a role into that sentiment. And I think if inflation is not as high as consumers expect, in other words, maybe you get the sticker shock at first, but then come to terms with where the prices are. I think that actually can play a positive surprise to consumers, where inflation is contained and it was really just expectations were for rising prices, and maybe they're not rising as high, and now all of a sudden affordability looks better.
But explain why we do not want deflation.
Deflation is when you have steadily declining prices, but really what happens is you have declining asset prices. And so you can think of your house or global financial crisis. Well, if housing values are below the value of the loan, well, you can walk away, and banks are insolvent, the loan's insolvent, and so forth. So deflation is kind of the killer. Inflation is a little bit different of an issue. We don't have deflation too much, but the design of the economy is to lend credit against assets or productive assets that will ultimately accrue value over time. And so deflation would be the opposite, where those values are just declining faster than the loan would be paying off, and you just get into this kind of debt spiral.
Right. Okay. Nobody wants that, even though I would really prefer to be paying less for eggs at the grocery store. Okay. We have to talk through oil prices. You brought it up already, Mark. Oil prices affect everything from inflation to geopolitics. What's your outlook here?
So this is a very good story about what's happening in oil. What's happened in oil and why it's in the $60 a barrel range versus maybe there was a few years back, estimates of 100, 120, 150, and we're at, we're not going to find any more. Well, our production has simply soared since the global financial crisis, circa '08. It's almost tripled since that time. So the U.S. has been the marginal producer. We are the largest producer of oil in the world. And so this has been just a really important story on containing oil prices overall. Historically, you would look at oil being geopolitical risk. Well, now that has lessened considerably because of our move into oil and production. Two, we've changed some of our trading relationships away from the Middle East, for example. So this was also part of why you'd get inflation, was the oil price, and now we're just not getting it, and so that's actually helped in the inflation front.
Okay. And this was the side that you had mentioned a second ago, the U.S. consumer. Despite higher rates, the U.S. consumer has held up. So what's supporting this resilience?
Well, I've had one rule in this business, and it'll work. It's worked 23 out of the last 25 years, which is essentially don't bet against the U.S. consumer. They will spend. And right now, regardless of how bad we feel, on the top left, our spending levels are exactly at the 20-year average. And so nothing has derailed spending. It's just consistent. And then the lower right here is household debt service ratio. So I know sometimes there's always, a bad headline about credit delinquencies or credit card balances or auto loans or whatever it happens to be. The reality is, at a macro level, what the market is more concerned about is household debt service ratios are actually at essentially, and this chart only goes back about 20 years, but they're essentially at 40-year lows.
Wow.
Much different than 07, 08, where we had debt service ratios very high. Here, actually very low. And then if you change that to even debt to assets ratios, because house prices have risen and the market's risen, that's at 40-year lows. So the condition and debt is not an impediment to continued spending.
And I think that will bring us to our next question here from Joan, who's asking about exposure to international markets because of, quote, uncertainty in US markets. Jordan and Mark, maybe you can both respond to that as far as whether investors should be nervous about what feels like an unsettled political time in the economy right now as well. Jordan?
Yeah, I think Mark hit on it earlier that, hey, yes, 2 months or so, there might be some volatility, but those geopolitical moves aren't affecting the long-term trend, the trend of the markets. Also, we do believe in international, but we don't want to ever weigh 100% into one sector. We want to have a portion that's maybe an international and be diversified, but we, for our clients, aren't going 100% domestic or 100% international. We want to make sure we have a plan to kind of make sure that we're fully diversified. No matter what does better this year, we make sure that we're still going to get those competitive returns.
Mark?
Yeah, and I would just add, the U.S. has dominated global markets in terms of the last 15 years. It's been U.S. led. So if you go back 15 years, the U.S. was about 40% of the all-country world index. Today, we're about 67% of the all-country world index. And so I think from BlackRock's perspective, they're just rebalancing these portfolios into areas that have been very undervalued relative to the U.S. And the U.S. leads in tech for sure, and that dominance. Most other economies don't have a lot of tech, but they have some resources if you go to Latin America. So that's come back into play. And then some other reasons to get into Europe due to undervaluation relative to the US. So it does make sense, as Jordan was saying, to have a globally diversified portfolio and have a certain percent in international to get that exposure. But you wouldn't put all of that in all of the portfolio in there, of course.
Right. Let's, though, talk about sentiment on stocks. When investor sentiment becomes elevated, how should long-term investors respond?
This is a mirror image in what I was referring to before of how consumer sentiment feels about their own situation. But if you change the question to, well, how do you think stocks will do? You have nearly a record percent saying, yes, stocks will be higher in a year. So using sentiment as a contrary indicator, we'd say, oh, this might be actually a little bit of a headwind because now everyone's just expecting this AI theme to continue to propel markets higher. So we'd see this as a bit of a headwind, but it does tell you that just that different story that the consumer feels good about stocks and not about their own situation. And I think this actually will play out a little bit differently, or kind of the opposite, where the consumer does a little bit better and AI gets some headwinds here. And we've seen that to start the year.
And again, this one dovetails back to Joan's question. What does foreign investor behavior tell us about global confidence in U.S. markets?
This chart might be very surprising to some. Over the last year, foreign investors have just increased their investments into the U.S. at a remarkable pace. $1.5 trillion, $750 billion in U.S. bonds, $750 billion in U.S. stocks. So despite all the different headlines, geopolitical changing risks and so forth, foreign investors found the U.S. the best place to allocate capital. We're the deepest, most liquid markets by far, most diverse economy by far. So it makes a lot of sense. But it is a bit of a, where it was a tailwind last year, I wouldn't expect that kind of investment again in 2026 because that investment was made in 2025. So that pace won't keep up. So that I don't think that will necessarily be a tailwind this year.
Okay. We got a question from John, which actually leads right into your next slide about the US dollar. I forget, Mark, how it's been deflated. I don't know if that word is correct in recent headlines, but I do want to talk through the dollar and gold. They're often sending competing signals. And this is John's question. How do you feel about the dollar not being as important as it was in terms of global currency? And I will pull up your chart.
Yeah. The dollar by far is still the most important currency. Now, the dollar will appreciate or depreciate in value relative to other currencies. It's a free floating currency. And the main beneficiary recently has been gold. Gold is usually inversely related to the US dollar. And so what this chart shows was that the dollar depreciated and gold appreciated by a pretty considerable amount over the last year or so. So we do want to keep a diversified portfolio, and the goal of any investment portfolio is to maintain your purchasing power over time and grow that purchasing power over time, essentially overcome inflation or any changes in the relative value of the dollar. But I would say coming into the year, the dollar was overvalued on a purchasing power parity basis by a pretty considerable amount. And so any decline or depreciation makes a lot of sense from that perspective. It was going to happen. And then there'd be beneficiaries, whether it's other currency, whether it's gold, but also stock prices are part of that move as well. And that includes both domestic and international. So I would say that gold has caught a bid as part of being another reserve asset for foreign central banks. That makes a lot of sense. They have not been selling treasuries per se. They just haven't been buying more. And so you have China and Brazil trying to trade with each other, and then Brazil trying to trade with Russia. Well, maybe you don't need the dollar, but they're certainly not using the kind of quote unquote BRICS currency that they talked about creating. And the reason for that is because they don't trust each other. None of their markets are deep or liquid enough to handle global capital flows. Only the US dollar is. Who has lost value has been the euro and the yen for sure. And that's definitely been replaced by other allocations. But gold would make sense because then and why they've used it is because, okay, now you can settle trade in any of those three economies using gold rather than kind of this other currency or their domestic currencies.
Mm-hmm. Again, we are grateful for everybody who's watching live. And just like our other viewers, if you would like to submit a question, please feel free to do that. Jordan, as we talk through these slides and questions with Mark, are there any questions that you're hearing frequently from clients right now?
I wouldn't say a lot of clients, but there is a few clients that are just like, hey, I got money on the sidelines. I like my CDs. I like my money markets. I'm waiting for the next correction. And personally, as a firm, we think CDs stand for certificates of disappointment because you're not really keeping up with inflation and you're being taxed on that if it's in a non-qualified account. But maybe just, Mark, can you talk to those people that are just maybe more conservative, a little hesitant, kind of what are maybe some more conservative options? Should they stay on the sidelines and wait for the dip? Kind of your perspective on that.
Yeah, studies would tell you that you don't need to wait on the sidelines waiting for a dip. In other words, whether you space in dollars, it's actually better to lump sum in. Though I can understand from a risk management standpoint that you could kind of slowly add to allocations, which makes sense if that's where your comfort level is when you're allocating. So we would say there's always opportunity in the market, and short-term volatility actually starts to fade. And what is the risk is the long-term, and you mentioned it, Jordan, the long-term inflation numbers. You want to keep up and outpace inflation over time. And despite a lot of declines from here to there, you're not going to get away from that. It's just how the market works, that the market has definitely overcome inflation and added significant real returns on top of that. So it does make sense to be prudent, and you can use a conservative allocation, but it's a mix of assets. And I think it makes a lot of sense. And as you mentioned, Jordan, you run nitrogen reports, which can illustrate kind of your range of returns. And I think it's an excellent tool.
Maybe just going that one step off the cuff, when it comes to inflation and CD rates, how do they correlate? Just as a information piece.
Very closely. So a lot of times it'll be a bit below the inflation rate. But again, that inflation rate is kind of a macro number. It doesn't actually tell you your consumption basket, where a lot of things that you're going to need or that are used in the real world are still rising in value. For example, part of the calculation would be to make an adjustment if all of a sudden you paid for a $500 TV a couple of years ago, and now you're going to a $2,000 TV, a big screen or what have you. You'd say, oh, I just spent 4 times more. Well, the calculation might say, well, wait a minute, the TV is actually 8 times better. So you've actually spent less. So it doesn't really correlate as well with these macro numbers. This is a market number versus your consumption basket, where there's education expenses, there's car expenses, there's housing expenses. All of those have outpaced, and medical expenses. All of those have outpaced the actual official inflation rate. And I think those are the important numbers you want to keep in mind when you're building that portfolio.
Agreed.
Jordan, to speak to your clients who are wondering when to jump back in, I understand, I empathize with that because, Mark, it feels like we've been on a tear for a while, right? So let's talk about the length of the cyclical bull market. This bull market has lasted a really long time. Does longevity alone increase the risk of a downturn? And for context, ARK Invest CEO Kathy Wood recently said she sees strong gains for US equities in the next few years, calling it a quote, new golden age.
And I understand her point about the next few years. So as we look out throughout the rest of the decade, I think there's more gains to be had in AI and that move. It's still early in its move, but in the short term here, we are a little bit cautious in the sense that the black line on this chart shows the average cyclical bull market. That means kind of rally off of a 20% bottom, which we had 20% decline, which we had in 2022. So we've been rallying essentially since late 2022. It started up slowly and then has kind of crept in. And so that green line there shows us that we're several months past the average, where you could get, just from being a little bit long in the tooth, where you're set up for a little bit of disappointment. And so you want to be mindful of that move. But that doesn't mean that it's over. It just means that we want to be cognizant of that. And I think that really lends itself towards maybe the theme of what we're talking about, rotation, where you could see the overall market decline because of the concentration in that one theme and those few sectors, and the rest of the market actually holds up or does definitely relatively better and could have positive returns. And so that's what I would say is probably the bigger term, which is the rotation impact of what's happening in the market.
Okay. We are getting to our last few questions here again. So friendly reminder that if you have any questions for Mark or Jordan, please submit them in the comments section so we can get to you before we end our live today. But I do want to talk about our last slide, which is cycle composites. When you put all of these indicators together, Mark, what does the broader cycle suggest about the road ahead?
So we use a 1, a 4, and a 10-year cycle analysis to give us a composite for what the year might look like. And this is just tendencies, and trend is more important than level in this chart. But what it definitely tells you is that there's an influence on the midterm election year and the second year of a presidential cycle. So the second year is historically the weakest year for the market overall out of the 4-year cycle. The third year is the strongest. And so we would expect some weakness throughout the year. The midterm also tells us that you have weakness, kind of the market is choppy up until about the election. And then once you get past that, then the market can start to look into 2027 and beyond, into the third year of the presidential cycle. You're past the midterm and so forth. So we're definitely cognizant of this kind of action in the market, that you could have a decent correction. Last year we had a correction, but it's pretty short-lived. Here it could just be a little bit elongated. And as I mentioned, some sectors actually may be doing pretty well. And it's just, again, those larger cap tech stocks that are a little bit weak or have that influence on the market overall.
Mm-hmm. I'm glad you brought up elections, just because, and again, back to our little dip in April, each time we as humans live through these corrections, the sentiment that I hear over and over again is, but this time it really feels different, right? And so to remind everybody who's watching, when you choose to work with Jordan, you're not just working with Jordan, you're working with a team of investment experts, Mark chief among them. But Mark, explain how relying on data as opposed to how we feel in these moments is better when it comes to being a long-term investor.
Well, you take the emotion out of it, and it gives you a sense of market history. Well, at any decline historically, there's been unknowns and uncertainties at those times. It's really been the dynamic U.S. economy and stocks that have pulled ourselves out of this. In other words, it's been resilient, it recovers and moves forward. So I would keep that in mind. And so we average, what's the average decline in any given year? It's 14%. What's the average decline when when January has been positive? Well, it's been about 10%. So it's not that declines don't happen. It's how we manage them. And I know Jordan has mentioned this, that you want to build that diversified portfolio, taking into account what your downside risk is. So we know there's volatility in the marketplace that is not going away, but through portfolio construction, we can reduce that risk consistent with your risk profile. So some people can assume a lot of volatility in the portfolio, and for that you'd expect higher returns. Well, there's want less volatility, so you have less exposure there, and maybe exposure to areas that have higher income and a lower volatility profile. There's no one right investment portfolio or one right investment. It's really that combination is where the portfolio construction concept that I think is the value add and the way to approach markets.
Mm-hmm.
And just to overlay that, for our clients, we create that plan. So if we have a plan, a lot of times we deal with people pre or in retirement. The markets may recover, but the one thing they don't have on their side is time, right? So we want to make sure that the money we might need for the next few years, we aren't as volatile on, because cycles will come in the markets, but what we need is to supply our lifestyle. We need to have money to spend and enjoy life, and we don't want that money to be too much at risk and too volatile if they do need to draw upon that. So we overlay the portfolio with the plan, with your income plan, and what your comfort level is to make sure you have peace of mind no matter what the markets do.
Mm-hmm. And it bears repeating, if your advisor is just talking about investments, you need a new advisor. Jordan, we have only scratched one little part of the puzzle here today. People who work with you, you have this patented safe and secure retirement roadmap. Explain how, again, investments are just one piece of a plan.
Yeah, maybe you're watching this, you aren't a client, and maybe you're an advisor, or a lot of people out there, they have just an advisor that focuses on the investments. And we take that seriously. We want you to get competitive returns. But what good is what you make if you give a big chunk of it right back to the IRS? Mm-hmm. So in every decision we do, we integrate tax planning. We can even prepare tax returns for our clients, because every financial decision does have a direct tax implication. So we align the two and integrate the two, and make sure we give you advice, not just on the investments, but on the tax impacts of those investments. We correlate that with that income plan when it comes to required minimum distributions, your lifestyle, making sure we navigate when to take money out, make sure it's not too overly exposed to the market. Also, I'm not a healthcare expert, but we have an entire Medicare team, long-term care specialists that help with that. We have attorneys that help with the legacy. But everything focuses really around the taxes. Obviously, Mark and our investment team is here to grow those assets. But what good is we grow it if we don't get to keep it all? So we want to make sure we keep the biggest chunk of that. And that's why tax plan's at the center of everything we do.
Mm-hmm. We do not have any final comments or questions. Jordan or Mark, do you have any final thoughts that you would like to share?
Mark, I'm going to give you a tee up. 2026. What's the final outcome in 2025? I just want to quote you. You gave us kind of a market update. You said on the fives, it's always positive and usually double digits. And I just want to cement that you got that right last year. So what's the forecast for this year?
Well, that was a good statistic for years that end in 5.
Yeah.
This year, I would say you might have a period where you have a decline, but then ultimately after the midterm, I think kind of the storm clouds move to brighter skies and the market responds positively. And it's hard to tell how sharp that kind of rebound could be. But that would lead you to a pretty good expectation for 2027 and beyond.
And again, everyone knows this. We can't predict the future. We can't promise you guaranteed returns. But ultimately, I think for everyone watching, the key to have peace of mind, because I believe money is a tool. Yes, we want to make money. Yes, we want to have it grow. But really, money should make a positive impact in your life. And I don't think any of us on this call want to be the richest person in the nursing home, right? We want to enjoy life. We want to make memories. We want to spend time with our family, make every second count. And if we can create a plan for you and give you that confidence and clarity, so you no longer have to worry and wonder, we did our job. We have that peace of mind that we helped you. You have that peace of mind so you can spend time with your most valuable resource, which is your family, your friends, and the things you want to do. And we thank you for being a part of our team and looking forward to help you all in the near future.
Yeah, this has been fun. Jordan, that being said, if somebody has any lingering questions, what's the best way to get a hold of you?
Yeah, if they watch this recorded, they can do comments. We respond to it, or they can call our main number, 847-499-3454. We can set up a conversation just to learn about your goals, your concerns, give you some insight, and maybe put together a plan to give you that peace of mind.
Wonderful. Jordan, Mark, everybody watching, thank you all for your time today.
Thank you, Aaron.
Thank you.